Hello and welcome back to another edition of Lipper's Fund Market Insight. I'm Matthew Lemieux. We're back again looking at weekly mutual fund flows for the week ending January 18th. And we're 3 weeks into the new year, and so far so good it seems for U.S. investors as all the equity markets are up, and we've got some more general optimism going forward through the year. Despite some news out of Europe of 9 downgrades by S&P, they continue to have some strong bond auctions, so really not as negative a reaction from the markets as maybe some may expected. Going forward, we're really kind of in the beginning stages of the 2011 Q4 earnings reports, but so far it's been a mixed bag, but we have a lot to go from here. So let's look at how this good news translated into our flows for the week. Overall, the conventional fund business pushed out about $2.9 billion. And if you see, most of that negative downside was from money market funds as they pushed out $7.3 billion for the week. But equity funds pulled in $800 million, and taxable bond funds continued to show some strong gains in flows with $2.6 billion for the week, and municipal debt continued to build some momentum with $1 billion in for the week. So let's go on to equities. As I said, so far the equity markets, we've seen some strength, some general optimism out there, especially in the U.S. Just about $800 million this week, and most of it going, that's a mixed bag. Domestic about $300 million, non-domestic about $400 million. Overall, this is the second consecutive week we've seen inflows into the equity group. But one thing, just to take a step back, is we usually kind of say, okay, what's mutual fund investors doing, but what about ETFs as well? If you look at ETFs and combine it there, those numbers go out to about $3.3 billion of inflows, so an extra $2.5 billion just from ETFs alone. Now, this isn't anything we've seen that's unusual, but what is unusual is in the past, we've seen a lot of this fluctuation really riding on the back of one or two ETFs, whether it be S&P 500, SPDR, SPY, or some other group in there that really kind of gets the interest. But across the board this week, we saw interest in large caps, small caps, energy, and even into some S&P Power Shares Triple Q, so into some tech funds as well. So really across the board, I think investors are really kind of taking another look at their equity allocation, looking at 2012, feeling a little optimistic and starting to put some money to work across the board. Let's go over to taxable bond funds. As I said, we continue to see strong flows into this group, which has been a story for quite some time now, $2.6 billion in this week. Fifth consecutive week of inflows for taxable bonds. And as you see, it's really split again between high yield and investment grade. High yield, I think, has been riding a little bit on the coattails of the positive mood in the equity market with about $800 million coming in. And there's still some interesting quality as investment grade pulls in $600 million. One group that I continue to kind of watch and seems interesting, even though it's really not a large of a group, is really the mortgage group. Ginnie Mae funds as well as General U.S. Mortgage. They pulled in about $500 million for the week. And one thing I find that interesting, because $500 million is really, compared to some of the other taxable bond groups, isn't that much. But on a 4-week moving average, we're seeing right around $400 million a week, and we haven't really seen that type of interest since 2002. So some investors really kind of focusing on mortgage funds going into that direction. Third group we're going to look at is muni debt funds. If you've been following us for quite some time, you know that they had their moments of real struggle within 2011. But since the end of the year and now into the new year, we've really seen some interest coming back into this group. $1 billion roughly in this week. Second week in a row we've seen inflows at that level. Actually, if you look at the past 15 weeks, 14 of them have been positive. So investors are feeling a little bit less concerned about possible defaults in the municipal space, putting money in there, getting some good returns, some good yield, and especially on a tax advantage basis. Most of this money this week, about $900 million, going into broad diversified national municipal debt funds. So the third group we're going to talk about, as we mentioned before, is money market funds. Money market funds, they had about $7.3 billion in outflows. And again, I looked at it as a positive note because where we saw those outflows was from the U.S. government and Treasury, about $4.7 billion. The reason I say that is up to this point, we've seen a lot of investors actually putting money into this group as a risk-off play because specifically they weren't as comfortable going into, say, the prime money market space or anything that may have had exposure to Europe. They really wanted to go somewhere where they felt their money was safe, which was this government and U.S. Treasury money market basis. So I think, again, some of that positive optimism in the U.S. markets kind of shifting some of that money out of that space and back into risk assets. So it's probably a good deal. And if you look at the macro groups across the board, money into equity, money into taxable bonds, money into muni, and money coming off the sidelines from money markets. So again, moving in the right direction for optimistic market participants. So going forward, what are we going to see? The reality is, as I mentioned a couple times now, is that we've seen extraordinary returns so far year to date in the markets. NASDAQ's up about 7%. S&P about 4.5%, and the Dow Jones about 3 1/3. So these are really good numbers so far this year. We'll have to see if they sustain. But so far, last week we got some news from initial jobless claims coming in at about $352,000. Best, or 352,000, not dollars, but people. Best since April 2008. So again, more optimism. That said, we can't forget about Europe and some of the other risk factors out there. Greece is working with some of their private lenders to come up with some kind of agreement. That really hasn't been met yet. And I think it's been a little quiet out of the Eurozone on the debt crisis just because the ECB has opened its lending facility, and we'll have to kind of see how that goes. Going forward, if you'd like to get a little bit more information on our fund flows, you can visit our website at www.lipperusfundflows.com. Otherwise, you can come back and visit us again next week when we talk about the flows. Thank you, and once again, my name is Matthew Lemieux.